Hey, what's going on everyone? It's Griffin here. So I actually wanted to release this video yesterday speaking about the Fed's new plan to start raising interest rates over the course of 2022, but a bunch of things came up. I wasn't able to get that video out, so here we are. Essentially, as investors, we've all been waiting quite patiently for the American Federal Reserve to divulge their plan regarding raising interest rates over the course of next year in the face of rampant inflation that we're experiencing right now. This is actually something that I've mentioned multiple times on the channel recently when speaking about the impacts that raising interest rates or just interest rates in general have on the equity markets as well as other asset classes, notably real estate. So I will save you from the long and drawn out backstory. Over the past 2 years, the American Federal Reserve has slashed down interest rates to near zero levels, in parallel to also increasing the money supply through distributing stimulus packages, all of which has resulted in above average levels of inflation that we are now experiencing. And to combat this, governments do have multiple different tools at their disposal, notably playing around with interest rates. And if you've been an investor over the past couple of years, you're probably real familiar with the markets moving quite violently on headlines as well as short-term news, but this is more of a big deal and will actually impact the market movements over the course of next year and beyond. So yeah, during Wednesday's trading period when this news was actually announced to the public, we saw pretty much bearish trading activity for the first half of the day, followed with a surge in equity prices, basically across the board, regardless of the stock as well as the industry. And this was pretty much upon the news of the Feds coming out with their new plan for interest rates over the course of 2022 all the way up to the end of 2024. So even though since that surge that we experienced in the second half of the trading period on Wednesday has sold since right back down to previous levels, well, this is very much, in my opinion, as a result of the Feds coming out with their plan for interest rates in 2022 being less harsh and severe as investors were anticipating. What's interesting though is that we're actually kind of seeing the Feds chasing interest rates right now, which we have not seen for over a decade at this point. So let's take a look at this right now. All right, so as you can see from the chart right here that we're going to unpack, as of right now, we're still in the period where we're experiencing those low interest rates in 2021 that we've been experiencing, and that's why we're able to, secure low interest rates on mortgages, borrow for cheap, and all of this has contributed to asset prices on the rise over the past 2 years. Now, what we've been waiting on though are these dots right here that don't look like much, but we're going to demystify these right now. So essentially, based on these projections, we should be seeing 3/4 point increases to the underlying interest rate over the course of 2022, which has been kept near zero again since March of 2020, right? And if we zoom back here on the past 5 years worth of interest rates, well, we can see quite clearly where the rates have been near zero for the better part now of 2 years. And finally, there are new plans coming out by the Feds for this to change in order to combat pandemic-induced inflation. So that's what we're looking at right now. And as you can see, over the course of the next years, we're seeing incremental increases in the underlying interest rate all the way through to the end of 2024. Interestingly though, if we do take a look at this press release, we can see that Jerome Powell, who's the Fed chair, also mentioned that the economic developments and changes in the outlook do warrant the evolution of monetary policy as of right now, and that the economy has actually been making rapid progress towards maximum employment, and that the improvements in the labor markets along with inflation is really what's driving their current decision at the Fed to increase the interest rates sooner than later, actually. So yeah, this is why right now there is a plan to gradually increase the interest rates all the way up to around 2.5% by the end of 2024. Because let's remember here that only a couple months back, we were pretty much in the dark as to what the Fed was going to decide to do moving forward. And they had mentioned previously that they were looking to start increasing interest rates in the third quarter of 2022, which would be around the fall. But they have since decided to move that significantly forward for the second as well as first quarter of 2022. And that's now what we're seeing based on this new information that was released. Realistically though, this 3-year plan that they've just released all the way until the end of 2024 could change dramatically over this course of time. Like, I'm not even looking at this more than this 2022 figures that they've since posted, because even 2022 figures could change dramatically over the course of the next months as well as the next quarters. So yeah, we're looking at 2022 here. It's not even nearly as aggressive as I was personally anticipating. I thought it would be closer to 1.5% in 2022. And the fact that we're seeing around 1% right now is, yeah, not as aggressive as I was anticipating. Let's just keep in mind here though that we're only able to basically make assumptions on the information that we have at hand. So it is extremely possible that inflation continues to rise to levels that are pretty much out of control like we saw back in 1980. That is extremely possible, and the Fed's decision to increase interest rates might once again change quite dramatically over the course of next year if again we do see those interest rates, or that inflation rate I should say, go out of control. That is one of their main tools for countering inflation. So yeah, we basically can only wait and see, but as of right now, this is the information that we have at hand. And if there's anything that we've learned over the past 2 years as investors, is that the Fed tries to ease into this new policy and provide information on an ongoing basis so that the market has ample time to price things into equity price points to avoid large pullbacks. My point being though is that if they've mentioned increasing interest rates to around 1% over the course of 2022, it would not surprise me if we see this actually be higher than 1%. However, that's just speculation on my end at this point. And if one thing is for certain over the past 2 years is that the Fed has done absolutely everything in their power to maintain the markets. And with Jerome Powell in office for another 4 years, he'll be holding on, doing everything he can to prop up the markets continuously. But the question now, of course, is how is this going to impact the stock market in 2022 and beyond? And of course, no one ultimately really knows what is going to happen on a concrete basis, but we do have historic data giving us some insight on what has happened when interest rates have risen. So really simply here, and we can go into significantly more detail, but we're going to keep it really basic. Typically, the relationship between interest rates and equity values is that when interest rates rise, the equity values go down from an actual underlying standpoint, so the PE value, but then also from a standpoint of the nominal price. And then the opposite is also true. When interest rates go down, usually this increases equity valuations and price points because it becomes cheaper to borrow, and so therefore companies are able to command higher price points because they're able to be more profitable, as well as the fact that you're able to, as an investor, create higher returns in the stock market than in fixed income instruments. So we can see this relationship firsthand when taking a look at this chart of the S&P 500's relative PE ratio. So we can see this all the way back to before 1980 when interest rates were extremely high. So we can see that back in 1980 when interest rates were very high, while the underlying price to earnings ratio of the S&P 500 was extremely low relative to what it is right now, where right now we're seeing it at above values of 20, and it has been since the beginning of the pandemic. This is a one-to-one correlation with the fact that the interest rates have been slashed down to near rock bottom levels. So this has allowed equities to continue running and increasing the value that they're able to command. So all this to say that with seeing the Fed's plan to keep interest rates actually quite low over the course of 2022, only raising it very gradually this year, even though it's possible that they do increase this more than what's anticipated right now, well, I could very much see the broad stock market continue to run over the course of next year. That is definitely a possibility based on the data that we have right now. And generally speaking, considering a market environment where interest rates are quite low, well, companies that are growing financially are able to continue commanding higher valuations, which is what we're seeing right now. So all this to say that for now, this could very well be a further catalyst for increased growth over the course of next year. And based on this data, I don't see there being a significant pullback or crash over the course of at least the next 12 months, unless again, we do see massive levels of inflation and the Fed deciding to change their decision to increase interest rates significantly more next year. All right, so let's now speak about what I'm personally doing in my portfolio based on this new information at hand. Realistically, this has not changed anything really in my investment strategy. Again, like this might sound like a broken record, but I don't trade on short-term news really unless it significantly impacts one of the companies I'm invested in or the funds that I'm invested in. I try to look at long-term trends in the market, and this is not something that for the time being is really negatively impacting my outlook on the markets and the companies that I'm invested in. In fact, just a couple of days, I made a video speaking about investing in ETFs at all-time highs. I'd highly recommend you check it out if you haven't already. I'll leave a link right here. But in that video, I was just talking about the long-term trend over the last 20, 30 years of consistently investing into the markets and how that really for the average investor is just the most powerful tool that you have at your disposal. And even further than that, I was looking at a video. I've been prepping an ETFs to buy video for early 2022. And I was looking at a video I made last year in January of 2021. In that video, I'd quickly given a market update. I'm just going to let you watch that for around 1 minute right now. Take a look. Now, in terms of the market environment that we're currently riding through, I think it's safe to say that there are quite a few unknowns and quite a bit of uncertainty regarding what to expect in the market over the course of 2021. Equity markets are once again trading at all-time highs following pretty much the quickest recession and rebound in history. The Federal Reserve has more money out in circulation than ever. We're in the process of a change in American governments. Interest rates are rock bottom, and the principles of investing are seemingly unclear for a lot of investors who just got into the market over the past year. There's also been a massive inflow of cash and new investors into the stock market since March 2020. So while it's been extremely lucrative to pick and choose individual growth stocks over the course of last year, it's also really important to remember as investors here that proper portfolio construction and asset allocation is critical to maintain a proper strategy moving forward for your needs as an investor, especially during a volatile market environment such as what we're living through right now. Right? So the point being here is that there's always going to be a reason to be fearful in the markets and thinking that everything is going to crash down, you're going to lose all your money. Like always, there's going to be negative headlines that are going to emotionally impact what you think is going to happen in the stock market. But if you just maintain that long-term outlook, typically this is going to be the best course of action for retail investors. And that pretty much wraps up the entire video. I just wanted to make a quick video here speaking about the Fed's plan to raise interest rates in 2022 because this is something that we've been anticipating as investors and will impact the equity market moving forward over the course of next year. So it's something that I definitely wanted all of you to be well aware of, as well as my thoughts on the matter. I really hope you enjoyed today's video. If you did, make sure to smash the like button and check out all the other content that I already have on my channel speaking about proper stock market investing based on your risk tolerance, as well as a long-term view with a portfolio that's crafted around your investor profile. Also, of course, make sure to check out all the links down below in the description to get some free money for opening up brokerage accounts, as well as the fact that you should check out Bull Runs, which is my full stock market research tool, as well as stock portfolio tracker. We've been updating things on a weekly basis here, adding new features, as well as changing up the pricing plan. So you can get a full free plan to access all the features. Make sure to check out the link down below. No credit card is required, and we're looking to create a really awesome community over there over the coming months. So with all that said, thanks a lot for watching, and I will see you in the next one.